Okay, good morning and welcome to this lesson. So in this lesson, I'm going to go through section A, question 1. Yes, so I'm going to go through this question. I'll try to make sure the lesson is as short as possible, but at the same time, ensuring that I'll explain all the concepts. Okay, so now I'll take it that you have got an idea about what investment appraisal is. All right, so let me just give you a brief overview. So investment appraisal, all right, it's just a method of assessing the viability of a project. Right, is this project viable or not? Right, so before you invest in a project, maybe you want to buy a machine, you want to buy a vehicle, right? You need to assess, is this machine, is this vehicle going to give us the required benefit, right? So the issue is this method that we're going to look at in this question, this investment appraisal technique is called net present value method. What this means is you've got the cost that you invest in the machine, and then there's a certain amount of money that you project is going to be earned by this machine. So you project over a certain period of time, and then you need to deduct all the cash outflows, right? And then you add back the cash inflows, right? And then you need to calculate the cost of capital. If you're given the cost of capital, good. The use of the cost of capital is for you to discount the cash flows. Cash flows from year 0 to year whatever year you've been given as the end of the period, the project, right? And then you find the net, right? So all the cash flows from year 1 until year, let's say year 3 in this context, you deduct the cost of the asset, right? It's going to give you what's called the net present value. And that net present value can either be positive or negative. And if it's positive or negative, what does that mean? What simply means, if it's positive, then the project is viable. Yeah, the management can carry on with the project. But if it's negative, it means the project is not viable, right? They should forgo it. That's a brief overview of what net present value is. So now let's go through the question. The question goes like this: DPOC are considering buying a new machine in order to produce a new product. The machine costs 2,800,000 kwacha and is expected to last for 3 years, at which time it will have an estimated scrap value of 1 million. So this cost is incurred in year 0. So year 0 simply means now. For the most part, unless you're given otherwise, the cost of the machine, the cost of the asset is always in year 0. And then this is supposed to be in brackets, and in brackets it simply means it's a cash outflow. You're buying a machine, money is going out of the business, it's a cash outflow. Then it will last for 3 years, right? The projection period, right, is 3 years. And then this asset is going to have a scrap value of 1 million. At the end of the year, you're going to sell it off for 1 million, and that is what's called a cash inflow. They expect to produce 100,000 units per annum of the new product, which will be sold for 20 kwacha per unit in the first year. Production costs per unit at current prices are as follows. So the reason why they've put at current prices, all right, is because these materials, 8 kwacha, labor 7 kwacha, that's the current price. In year 0, the materials cost 8 kwacha per unit, labor costs 7 kwacha per unit. So now what this simply means is, when you are inflating, if you're given at current prices, inflation is supposed to start in the first year, right? I'll say it again, when you're given prices at current market rates, at current market prices, inflation needs to start in the first year. So for instance, here we've given materials are expected to inflate at 8% per annum. You inflate from the first year until the 3rd year. Labor is expected to inflate at 5% per annum. You inflate from year 1 until year what? Until year 3. Fixed overheads of the company currently amounts to 1 million. The management accountant has decided that 20% of these should be absorbed into the new product. Alright? The company expects to be able to increase the sales price of the product by 7% per annum. An additional 200,000 of working capital will be required at the start of the project. Right? So remember, the price, what have we been told about the price? The price, we've been told that the company expects to be able to increase selling price of the product by 7%. Now, this price that we've been given for the price for the product, right? It's in the first year. So if the price is in the first year, this inflation of 7% is going to begin in the second year until the third year. The other issue that we have here, we've got the absorbed overheads, right? These absorbed overheads, the problem that we have is that there's no, in the notes, I don't know, maybe you've learned, but for me, in the books, I think there's no express statement saying overheads, absorbed overheads should not be included or should be included as part of the expenses. But I'm going to use the knowledge I have from advanced management accounting. So in advanced management accounting, in decision accounting, they say absorbed overheads, they are irrelevant for decision making. But those overheads which have been incurred, they are relevant for decision making. So that's the idea I'm going to use in this example that we're going through. So if I'm wrong, I think I'll just do further research. But I'm using that idea saying, okay, these absorbed overheads, they are irrelevant for decision making. So if that's the case, it simply means these overheads, we don't have to include them in our investment appraisal. Then we've been given capital allowances at 25% reducing balance, and then tax 30% 1 year in arrears. So if you've been given tax 1 year in arrears, it simply means the tax, you need to start charging tax from year 2 until year 4. And these capital allowances, right, these are a gain, or rather a benefit on a tax benefit on capital allowances, right? These are also supposed to be consistent with the year in which you charge the tax. And then we've been given the cost of capital at 10%. So there's not much to do here. We don't really need to calculate the cost of capital. So this is good. So the question is, calculate the net present value and advise whether or not it should be accepted. So let's begin. Let me open my Excel here. So the first thing that we need to do, we need to put item here. Then we say year 0. Alright, we've got year 0, we've got year 1, we've got year 2, and we also have year number 3. And then I think we also have year number 4 because of the tax which is paid in arrears. Then we've got the kwacha there, we've got the kwacha there, kwacha, and kwacha. Okay, so now the first thing that we need to do, given the question that we have, we need to find the contribution, right? And after we find the contribution, then we need to find the tax. After we find the tax, right, and then we need to add back the tax savings on capital allowances, and then we need to deduct the cost in the residue value when we sell the asset, and then we also need to include the working capital. So let's begin with the sales. For me, I usually begin in per unit. So being given, so let's say that's kwacha 1,000, and then this is also kwacha 1,000, this is also kwacha 1,000, to reduce the numbers so that we don't have a lot of zeros that we're dealing with. Reduce the numbers. This is why I put in this kwacha. So now sales, what is the sales? So the sales that we have here, we've been told that the sales price is 20 per unit in the first year. So we just said 20 here in the first unit. Remember, this 20 kwacha is going to inflate. And when does it start inflating? In the second year. So we say, where's my calculator? Let me just look for my calculator. Okay, I found my calculator. Okay, so we've got 20 kwacha. 20 kwacha multiplied by 1.07. That's how we inflate. 1.07. It's going to give us 21.4. 21.4. Just say 21.40. And then we also inflate this same 21.140, multiply that by 7 because the inflation is 7%. Then we have got 22.89, which is 898, which is just 22.90. Right? Then the next thing that we have here is materials. Materials, remember the materials, these are current market prices. So we inflate them starting from year 1. Materials are being inflated by 8%. So 8 times 1.08 is giving us 8.64. So we've got brackets 8.64. Close brackets. The next thing that we have, right, we continue inflating this. Right, the inflation is 8%. So 8.64, multiply that by 8% times 1.08. So 8.64 times 1.08. It's giving us 9.33. So that 9.33 is supposed to be in brackets. Don't forget the brackets. Then 9.33, you multiply that by 1.08. It's giving us 10.07 or 10.08 rather. And this 10.08 is supposed to be in brackets. So you've got materials here. Right? What's next? The next thing is labor. Labor cost is 7 kwacha. And this 7 kwacha is the current market price and it's being inflated, right, starting from year 1. Right? So we've got 7 times. It's been inflated starting from year 1. What's the inflation? 0.5. Let's just say 5%. So it's just 7 times 1.05. It's going to give us 7.35. So in brackets, you say 7.35. Close brackets. Times 1.05 again. It's going to give us 7.72. Right? The same amount we multiply by 1.05. It's going to give us 8.10. Close brackets. And then what do we do now? We need to find the contribution per unit. We say contribution per unit. So what we find, this thing that we find here, this amount that we find here is the contribution per what? Contribution per unit. Alright, so let's do the math. So 20 minus 8.64 minus 7.35 is giving us 4.0. 4.01 rather, not 10. Then 21.4 minus 9.33 minus 7.72 is giving us 4.35. 4.35. And then 22.9 minus 10.08 minus 8.1 is giving us 4.72. And then we say units, right? The units that are produced is 100,000. I've seen here 100,000, right? So we just say 100. 100 multiply by 100, multiply that by 100. And then we're going to have the total contribution. All right? So now this total contribution is just 100 times 4.01, which is 401, right? And then 435 times 100, or 4.35, which is going to give us 435. 4.72, which is going to give us 472. So then we found the total contribution. So now from here, what do we do next? The next thing that we do is we deduct the tax. Remember, the tax is at 30% and the tax is in arrears, right? The tax is at 30% and the tax is in arrears, right? So we say, let's say 401, right? 401 multiplied by 0.3 it's giving us 120.3, 120.3. So this is supposed to be in bracket 120.3, and then 435 times 0.3 is giving us 130.5. Then we have 472 times 0.3 is giving us 141.6, right? And then the next thing that we need to include here is the write down allowance, right? Write down value or write down allowance. So that's the WDV, right? The WDV. So now how do we find the WDV? We find the WDV as follows. So this is the simple format that you need to use. First you say year, so just say Y, and then cost, and then you have the capital allowance, and then you've got the tax here, and then you've got the WDV, right? Then what do you do now? So let's just also put the currency here, right? You also put the currency is in thousands, right? Then here also quarter, thousands, and then here also quarter, thousand. So now what's the cost, right? Well, the other issue that you need to understand is this write down allowance, the WDV, is supposed to be consistent with the tax, right? So the tax is paid in arrears. So in year 2, year 3, and year 4, it simply means even the write down allowance is supposed to be the same. So 2, 3, and then year 4, right? So now what's the cost of this asset? The cost of the asset is 2,800,000. 2,800,000. So 2,800,000. What is the capital allowance? The capital allowance, we've been given that the capital allowance is 25%. So you get the cost. 2,800 times 0.25 is giving us 700. Right? So let's write it down before we look at the tax. So now we say 2,800, right, minus 700, it's going to give us 2,100. And then this 2,100 we multiplied by 0.25, right? For us to find the capital allowance, it's going to give us 525. And then this 2,100, you deduct the 252 or 525. The 525 is going to give us 1,575. Then remember, this asset was sold off at how much? 1 million, right? So now what's the capital allowance here? So we don't actually, sorry, let me not say that. In the year in which the asset, right, is sold off, we have what we call a balancing allowance or a balancing charge. How do we find the balancing allowance or the balancing charge? We need to deduct the income tax value. So this is the income tax value, right? So let me just say not cost, but I think I'll say income tax value. So this is the income tax value, right? This income tax value, when you want to find the capital allowance or the capital charge, or no, sorry, the balancing charge or balancing allowance, right? We need to deduct the disposal proceeds. So these are the disposal proceeds, right? We need to deduct them from the income tax value. So this minus this is going to give us the balancing charge, sorry, the balancing allowance. If this amount was negative, let's say the income tax value was 1,000, or let me just say the asset was sold for 2,000, right? The difference between the two, this income tax value is lower than the disposal proceed. It simply means that's a balancing charge, right? So next, 30, you multiply by 30%, you multiply by 30%, you multiply by 30%. Then you're going to find the write down allowance. So 700 times 0.3 is giving us 210. Then 525 times 0.3 is giving us 157.5. And then 575 times 0.3 is giving us 172.5. So these are the WDVs. This is the write down allowance. This is the tax benefit on the capital allowances, right? So these same amounts, they're the ones we bring here. We say 210 here, and then we say 157 here, and then we say 172.5. What's next now? The next thing that we need to include is the cost. The cost of the asset is in year 0, which is supposed to be in brackets, which is 2,800,000, right? And then the disposal proceeds are in year 3. These are a cash inflow, so they're positive. Then the other thing that we have is working capital, right? We also include the working capital. So this working capital, usually you follow what the question has been told. So here we've been told an additional working capital of 200, right? 200,000 of working capital will be required at the start of the project. When does the project start? The project starts in year number 1. So we say working capital. So working capital is supposed to be a cash outflow. We're buying working capital, and then in the final year, when the project comes to a close, this amount is supposed to be recovered, right? So with that done, what we need to find now is the total cash flows, or we just say cash flows, not total cash flows, because there's some deduction here. We just say cash flows. So here this is negative 2,800,000, and then here so let's find the so let me just do that for me not to calculate. So let's just say alright, so this 20 minus we already found this up to here, right? So contribution multiplied by 401. Okay, so we're starting from here actually. So we're starting from the total contribution. So this minus this, right, is obviously going to give us 201. So 401, right, we deduct that 200, right, which is going to give us 201. And then 120, so we've got 435, you deduct 120.3, and then you add 210. It's going to give us 524.7. And then we have 472 minus 130.5 plus 157 plus 1,000, right, plus the working capital of 200, giving us 1698.5. Then 141, so just say 172.5 minus 141.6 is giving us 30.9. So here the next thing that we need to do, we need to discount. So we just say discount factor of 10%, right? So now, where do we get these figures from? How do we discount? Right, you'll be given these figures, you don't really need to calculate anything. So you'll be given these figures. Let me just get one of the Zika papers, right? This is where we're going to find the present value tables. So just a minute. Okay, so yeah, so this is the present value table that we have here. This is the present value table, right? So this is the present value also of the annuity table. So this present value table, right, our discount factor is 10%. So this 10%, we go where there's 10%. And then our year is running from year 1, year 2, year 3 until year 4. So we get these figures: year 1, year 2, year 3, and then year 4, right? In year 0, the discount factor is 1. So we just put 1. Always remember that. In year 0, it's 1. Then here, year 2, right, our discount factor is what? Our discount factor is 0.09. So 0.909. And then in year 2, our discount factor is 0.826. We've got 0.826. And then we've got 0.751. In year 3, 0.751. And then in year 4, we have 0.683. 0.683. And then we're going to have what we call, these are discounted cash flows. So now, this 2,800, 2,800,000 rather, stays like that. It's still a negative. So here we say 201, right? 201 multiplied by 0.909 is giving us 182. 182.71. Then 524.7 multiplied by 0.826 is giving us 433.40. And then the next thing that we have is 1698.5. you multiply by 0.751. So it's giving us 1275.57. And then the next thing that we have is 30.9 multiplied by 0.683, giving us 21.10. Then we need to find the total for these and then deduct this. So we have 21.1 plus 1275.57, then plus 433.4 plus 182.71, right? Then we deduct the 2,800, it's giving us negative 887.22. Close brackets. And this is what's called the net present value. So now, what is the result? The result is that the net present value is negative. And what does this mean? What this means, so in the question we've been told, give advice whether or not it should be accepted. So what do we say? We say, since the NPV is negative, it implies that the project is not viable, right? The project is not viable. Thus, management must not undertake the project. With that said, then we've finished the question, right? So this is how you sort out investment appraisal. using the net present value method. I hope I've helped you out. Yeah, if you have any other question, you can still ask. I'm open for questions and any help that you might need. But this is the way we carry out the net present value calculation. Thank you.